Hi guys. Today we will analyze Netflix stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Netflix's overall performance in the market is below average. Also recent evolutions are not positive. Both the long and short-term trends are negative. It is better to avoid buying stocks with negative trends. Strong support levels are around $340 and $290. Next strong support level is around $250. Resistance level is around $392. The next resistance levels are around $460 and $510. In the last month the stock has been trading between $330 and $397 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 6 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a strong downward trend since November 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 28% per year, for last 5 years. We see that the average profit margin of the stock has been around 10% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Netflix company: bad, average, and good. First scenario. Netflix will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 12%. Future profit margin would be a low, 8%. Future free cash flow to net income rate would be a low, 70%. In this case, the fair value of the stock today would be $120. Second scenario. Netflix will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 14%. Future profit margin would be average, 9%. Future free cash flow to net income rate would be average, 80%. In this case, the fair value of the stock today would be $161. Third scenario. Netflix will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 16%. Future profit margin would be high, 10%. Future free cash flow to net income rate would be high, 90%. In this case, the fair value of the stock today would be $212. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 11.24. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Netflix, analysts forecast growth rate around 16% per year in next 5 years, and future P/E around 32. Again, I will use 3 different scenarios for Netflix company: bad, average, and good. First scenario. Netflix will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 12%. Future P/E would be a low, 12. In this case, the fair value of the stock today would be $135. Second scenario. Netflix will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 14%. Future P/E would be average, 14. In this case, The fair value of the stock today would be $185. Third scenario. Netflix will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 16%. Future PE would be high, 16. In this case, the fair value of the stock today would be $247. As you can see, today the stock is overvalued, $374, even if we expect the company's high performance in future. Netflix has just raised monthly prices for its streaming service in North America, and new polls suggest that many users plan to cancel their subscriptions. It seems Netflix has a rough road ahead. And the stock is currently too overpriced. Also, the stock has been in a strong downward trend since November 2021. I'm not interested in buying the stock, because I don't see it as a long-term investment. However, I may reconsider if the stock drops below $250. Company strengths. Netflix is an internet subscription video on-demand distributor of movies and television shows, worldwide except China. Members have unlimited access to the Netflix content library for a fixed monthly subscription fee. Netflix derives about 49% of its revenue from outside the US. Netflix has become an industry powerhouse. It is now competing with the traditional Hollywood studios for viewers and top industry talent, and driving the future of entertainment. Since 2013, Netflix has continued to produce popular original content while also expanding globally, adding new subscribers, and strengthening its industry position. The COVID-19 pandemic further accelerated the trend toward digital streaming video. Netflix continues to tweak its distribution model with low to no-cost mobile subscription plans in developing markets. It also announced the expansion of low or no-cost plan options to 78 countries in Southeast Asia and Africa. These low-cost mobile plans are attracting new subscribers and adding to revenue. While the other Hollywood studios have now launched their own streaming services, they all, with the exception of Disney, remain far behind Netflix. Netflix's subscriber base of more than 222 million far exceeds those of competitors, presenting a classic case of first-mover advantage. Netflix's return on assets of 11% and return on equity of 32% are amongst the best returns of the industry. Its profit margin of 17% is amongst the best returns of the industry. The revenue is expected to grow by 16 to 20% on average over the next 5 years. The earnings per share is expected to grow by 20% on average over the next 5 years. Risks. Netflix shares are very volatile, as risks abound on many fronts. Its shares are highly sensitive to subscriber addition metrics, and the company often faces seasonal weakness in the second and third quarters. The Hollywood studios subsequently launched their own digital streaming services, and as the market has matured, they have pulled their premium library content back from Netflix to drive subscribers to their own services. Streaming video from YouTube, Facebook, and other digital social media services provides another strong competitive vector for Netflix. People are canceling their Netflix subscription for other streaming services. With its widely known brand, the company could be a target for hacker attacks aimed at shutting down the service, or compromising member data. There are some minor concerns on Netflix financial health. The company may have some problems paying its short-term obligations. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.